I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, Ellen Brown from Web of Debt. Ellen Brown, thank you for joining us today on USAWatchdog.com.
Thanks, Greg.
I know you're also running for treasurer in the state of California, and you also are an attorney and a prolific writer on Web of Debt. And I just wanted to bring up one of your most recent articles about LIBOR, the London Interbank Offered Rate, which is how they set trillions, hundreds of trillions of interest rates globally on LIBOR. And there's been a lot of scandal and fraud and rate rigging on a massive scale. And now the FDIC is also jumping on board and suing over all this fraud. Tell me about what this means to the average person.
Well, the FDIC suit is different from the others. Most of the previous suits were about antitrust and RICO, that's racketeering, which are federal claims. And they were all consolidated into a New York court. And the judge ruled that although these 16 of the world's largest banks, which Bill Black on your program called the largest cartel in history, so illegal cartel, I think he said it was the largest cartel by a factor of 3 or 4, that clearly a criminal conspiracy. But the judge in New York said that it wasn't antitrust and it wasn't RICO, it wasn't racketeering, because they weren't actually competing with each other, and that you have to have competition in order to bring those claims, that they were actually colluding with each other. I mean, my argument would be, well, no, they were competing with the rest of us or competing with the other banks in order to take advantage of this criminal conspiracy to set the rate. But
let me just interject here. Do you think the judge is that stupid? Do you think the judge is just covering Wall Street bankers who is in New York, the New York district?
Yeah, it does look like somebody got to her. And I clerked in court for 2 years. My first job out of school when I was pregnant. It was a good place to hide. And the judges I worked for were honest. But I would imagine that there are certain suits that they care about, at that upper level, and somebody probably approaches judges and suggests the result that they want.
We don't have any. I just want to say we don't have any evidence of that, but it sure sounds.
No, but it looks suspicious. It just did not look like a good ruling to me, and it's on appeal. But in the meantime, the interesting thing about the RICO or the FDIC case is that they're bringing ordinary common law claims for fraud and breach of contract and conspiracy to commit fraud, among other things. That they have 24 counts, but they're emphasizing these fraud charges, which you could bring in any state court. California could bring those, and I'm in California, so I certainly think that's what should happen. The University of California should bring that type of charge. They were one of many victims. Well, just like Harvard. That's the reason all these tuitions have gone up, or a major reason is that they have these huge costs from their interest rate swaps that went against them. And I would argue that they went against them not only because of manipulation of LIBOR, but also because the Federal Reserve itself is the head of the private banking system and pushed rates very low.
Well, in your article, you used the words financial fraud, racketeering, and antitrust, and the Federal Reserve as the biggest, enabler of this. When you say fraud, racketeering, antitrust, and the Federal Reserve in the same sentence, and it's not because they're doing some enforcement action, in Houston, we have a problem.
Yeah. Well, the Federal Reserve, as we know, is composed of 12 branches, all of which are 100% owned by the banks in their district. And the biggest and most influential of those districts by far has always been the New York Fed. And Jamie Dimon, for example, sits on the board of the New York Fed, and it's clearly controlled by the biggest Wall Street banks. So it's virtually admittedly working for the banks, and all their actions since 2008 have served the banks, like quantitative easing, which I think should have been directed toward the real economy, but instead it just is directed toward the banks.
Well, quantitative. In other words, we should have put money in the hands of people. If you really wanted to get the economy going, you could have, you could have sent everybody $1,000 check and said, go make a down payment on something. I mean, it's crazy. I mean, the Fed's balance sheet is over $4 trillion. That's what they admit to. And we can't do an independent audit. We have to go by, what they say. And we for Bernie Sanders, the independent from Vermont, put in the FinRed bill at a one-time audit, and at the time it was like, it was 3.3 trillion, I mean, something like that, $4 trillion that we spent on this crash of 2008. This is in 2010 or 11, and then we find out, it was really 16.2 trillion. Right. This is unbelievable. Yeah. The fraud in the system is, and this is the biggest cartel and the biggest fraud in the history of at least interest rates, is it not?
Right. Well, those were loans to the banks, but they were loans at I suppose it was at the Federal Reserve rate, which is the federal discount rate, which is 0.75%. And then you have the Fed funds rate, which is at 0.25%, like extremely low. And we don't get to borrow at those rates. And that is, I had to look a long time to find this, but that is the fraud involved, the major fraud involved in the interest rate swap problem. It's not just that the state and local governments made a bad bet, and the universities and the hospitals and all the entities that got stuck in these things. It's not just that they wanted a fixed rate and then rates went all the way low, and so they wound up paying a lot more than the market. It's that the rates that they were paying to the bank is on a totally different scale than the rates that the bank was paying to them. So the banks were paying out at the LIBOR rate, which was the rate at which banks could borrow from each other, which is they had set very, very low, like 0.25%, something like that. And the rates that the banks had to pay back to, the rates that the public entities had to pay back to the banks were based on the bond rate, which is something called SIFMA or something, SIFMA, something I'd never heard of before. But anyway, it's a totally different standard. So they're paying on their bonds, whatever,
like 3 or 5%.
Whatever the going interest rate was on the bond, and they're paying this fixed rate on their interest rate swap, while meanwhile the banks are paying them the LIBOR rate. So there's a huge gap there. So they're paying not just the fixed rate that they bargained for, but this extra difference between what they're getting from the banks on their swap and what they have to pay out on their actual bonds.
And it doesn't it come down to a huge profit for the banks based on rate rigging and fraud, as you say, racketeering, antitrust? Isn't that how they made money? The business model is fraud, racketeering, and antitrust in this case, according to you?
Yes. That's why I would love to see, that's what I'm writing about. I would love to see a California jury get a hold of this, like for University of California. Juries give 30 times damages. They don't just give 3 times like you get in RICO claim. You could get very high damages from an outraged jury. Now, the reason that the University of California hasn't brought a suit is that the man who is their chief financial officer actually worked for Lehman Brothers in 2007 when he was instrumental in setting up these interest rate swaps, and he's been doing swaps ever since. So he's went through the revolving door, and he's not particularly inclined to sue his own people. But I think a claim should be brought, and I'd like to see what a jury did with it.
Well, isn't this an overall problem of crime and fraud in general? Most recently, here's a little more than a week ago, I'll put my glasses on and read this. This is SAC Capital, right? And this is according to USA Today. And USA Today reports this like, And it's and this is just another on the ongoing. I know you've written about all this fraud and crime, and you've had you quoted Dr. Black. The settlement sentence includes a $900 million fine that prosecutors termed the largest financial penalty, and here's the good part, ever in a criminal insider trading case. Hey, FBI, did you forget how to prosecute people criminally? hey, government, you're going after a rancher for turtles that aren't so endangered about grazing rights, and this is okay, just pay a fine. You know what that sounds like? It sounds like what the government, I mean, Jamie Dimon and, J.P. Morgan Chase, his folks over there are being sued for this Bernie Madoff scandal and for other scandals. Where they got to pay a fine, they helped Bernie Madoff in this $60-some-odd billion fraud, just pay a fine. It sounds like the government just wants a piece of the action. They don't want to prosecute anybody and put the people that are making them money in jail. We just want a piece. Here's another criminal case. I know I'm ranting, but according to the newspaper, a criminal insider trading case. Hey, FBI, did you forget how to prosecute financial crime?
Right. No, nobody goes to jail. Nobody at the top goes to jail. But also, these fines, of course, they're just the cost of doing business for the banks, but they don't really help us. But that's why I think it's so interesting, the possibility of bringing some civil actions for actual damages. If we got all the state and local governments that are involved in interest rate swaps, all the hospitals, pension funds, universities, all across the country, if they all sued for fraud and breach of contract, and they brought it in front of their own local juries, who are the people that are paying those high tuitions and paying those rates, we could have some serious penalty judgments that would actually go into the pockets of the people, or at least into the pockets of the state and local governments, which could reduce their taxes, lower tuition, etc.
At least get some of their money back.
Right. And not only get their money back, another thing they can get out of these deals. That's one reason that we're still stuck with these swaps, is that the penalties are so high for getting out of them that these entities just keep paying, even though they know it's a really bad deal. But if for fraud and for breach of contract, you can get rescission. That means you can get out of the deal. If you didn't, even in straight old breach of contract, if you didn't get the deal that you bargained for, that's grounds for terminating the contract.
Warranties and representations. It has to be what you say it is. And
right.
And if you didn't say, hey, this is a big fraud deal, we're going to rip you off, I mean, unless they disclose that.
Right.
And this is happening, in your estimation, all over the country with municipalities, state governments, universities. This is happening
Detroit.
all over nationwide.
Right. The first one was Jefferson County in Alabama. I mean, the first we heard a lot about, and then, well, I guess Orange County in California before that. But Detroit, that was a major factor bringing down Detroit. New York and Chicago and LA all have these big, burdensome interest rate swaps. They've got them all over.
All over the country. And, as in closing here, I know you've written a lot about this, too, as well. You're warning people about the bail-in scenario. And nowhere is it raising its ugly head more than over in Europe. And that they're finalizing plans that they're going to take bondholders and depositors and above 100 euros. But what happened in Cyprus was you couldn't get to your money, period, whether you had 100,000, I should say, euro, or €1,000,000 or 10,000 euro. You can have just only so much, a few hundred euro a day out of your account. That was it. It ruins people. Tell me about this bail-in scenario coming from over in Europe and ending up over here in America.
Well, they've just formalized this banking union that they've been working on for a long time, where all the Eurozone countries would effectively bail out their bankrupt banks, 130 banks that are subject to, or that could be bailed out under this fund. But before they tap up the fund, they're supposed to go after the creditors. And the creditors, first, of course, would be the stockholders and the bondholders. But the largest class of creditor of any bank is the depositors. Now, it says in the deal, in the banking union, that exempted are the insured depositors. Those are under 100,000 euros. But the trouble is, it was supposed to be a three-pillared settlement, or three-pillared deal, and the third pillar was deposit insurance that would be covered by the EU, and they didn't agree on that. So what you're stuck with is the deposit insurance of your local banks that get together, and it's like the FDIC collects premiums from all the banks in the country, and that's their fund, that is the FDIC fund. Well, the FDIC fund covers less than 1.5% of the deposits that it's supposed to be insuring. So you could just imagine a meltdown in Europe, which seems likely because those banks are so incredibly shaky, although they're not revealing how shaky until after this deal is in place. But you could just imagine if a number of those banks go down, they're not going to have the money in those insurance funds to cover the deposits. So you're still out of luck. You're out of luck till they come up with the funds.
I think here they have, I don't know, 10 around, I mean, we're using rough numbers, 44, 50 billion, something like that. Less than 50 billion insure 10 trillion in deposits. And then of that, insured deposits are about 6 trillion. I mean,
so are you talking about the U.S.?
Yes, in the U.S., yeah. The FDIC has
30 billion the last time I looked was in the fund. Yeah, and it's 32 billion in the fund.
And to insure, I think the insured deposit of $250,000 is something like 6 trillion. Overall, we have about 10 trillion in deposits on the bank, which I can't believe anybody would have that kind of extra money. An additional 4 trillion with no insurance. They're trusting the banks. Here could what's happening in Europe, the bail-in scenario hit America, and do you think it will hit America?
It could, and I think it will, because they don't have any alternative if they're gonna keep these banks alive. They have to reduce their liabilities. There's no way to make the asset side of their balance sheets good, and so they're reducing the liabilities. And I mean, I saw a paper on that I think it was from the BIS that this is the solution. Not to worry, we'll just knock down the liabilities, and then we'll be solvent again. But what that means is we'll be taking the depositors' money.
And you think that's coming to America?
Right. Well, J.P. Morgan Chase has $1 trillion in deposits, and so does Bank of America, way more than the FDIC fund would cover. And they're they're gambling. Well, just even take the interest rate swaps. What if the interest rate is raised on the swaps? They're going to have to pay out a lot. And more than that will probably bankrupt them right there if interest rates really went up significantly. So that's $1 trillion in deposits covered by 32 billion by the FDIC. And it used to be the FDIC could hit up the Treasury, the U.S. Treasury, but now they can't because it's in the Dodd-Frank Act that we're not going to bail them out in the event of a derivatives type bust.
So you don't keep a lot of money in your bank, I take it?
No, I don't think. Most people, I think, keep their money somewhere else, but it's the little people who do keep their money in the bank because they don't have enough to put it, whatever, in the stock market or somewhere else.
And you think that just because your account says, "Oh, I'm insured to $250,000," and I've only got $150,000, and no insured deposits ever lost money, they're going to break that record, aren't they? They're going to break that string of no insured deposit has lost money in your estimation, because there's not enough money there.
Right, and they're making it legal. I mean, they're just saying this is what we should do. This is what will be done in the event that you're not solvent. They're too big to fail. They can't allow these banks to fail. So what will they do? They will take the deposits and case solved. And we can't even sue them because that's the actual recommendation from the Bank for International Settlements or the Financial Stability Board, which is part of or in the same building as the Bank for International Settlements in Basel, Switzerland. That says that the G20 countries are supposed to do it that way. So even if we try to sue J.P. Morgan for taking our deposits, they'll say, nope, that's what we were told to do. Living wills, that's the way we set it up. They approved it. We did it.
So stealing and fraud is the ongoing business model for American banks.
Right.
Ellen Brown, of course, you write with the blog with the name Web of Debt. And, of course, it really is ellenbrown.com. Ellen Brown, again, thank you so much for joining us today on usawatchdog.com.
Thank you, Greg.